So they're trying to buy some of the GameStop. The GameStop. Hello and welcome back to another video. So if you've been paying any attention at all to maybe news or just paying attention to any bit of the stock market, you've probably heard or seen of the crazy GameStop short squeeze that's happening. And so you've probably seen that GameStop has grown a whopping 14,000% in the past year, not even a year really, from its low of $2.57 to its all-time high of $380 in the past 52 weeks. And really, in less than a month from the start of this year, from January 2021, it started out at around $18-ish to the $336 it is right now at the time of this recording. It's already grown 1,600%. So really, if you look at the graph, it's like asymptotic. It goes like this. Like every time I look at the graph, if you go to Google and you just type in GameStop stock and you look at it, zoom out to the max, it's like this. And I just laugh every time I see it because it's just so unbelievable. But anyway, in this video, I wanted to talk about why this is happening, how this occurred, and what I plan on doing. So stay tuned. So just to give some background, GameStop is basically brick and mortar stores that sell, video games, video game consoles. And back in the day when Nintendo, Wii, the DS was really hot, GameStop was basically the place to go, and it was pretty known for buying back your used games, used consoles for very cheap. But their business model is mostly focused on the brick and mortar where you walk into a store and buy it. But now with games, transitioning to be more downloadable, more online games, and especially with coronavirus hitting, GameStop's business model is suffering because of that. And they've announced that they're going to close more than 1,000 stores by March of 2021, and they have a negative earnings per share, which basically means they're not profitable and they're losing money. So that's some background on GameStop. I also want to give some background on what short selling is because, as this video explains, we are talking about the GameStop short squeeze. So what short selling basically is the normal stocks, you buy a stock and you hope it goes up in value so you can sell it at that higher value. So short selling is kind of the opposite of that, and you hope the business does worse because what happens is, if you want to short a stock, say GameStop for example, what they'll do is they'll borrow shares and they'll sell those borrowed shares at a price, and they hope that the stock price will go down in value. They hope the business does worse so that when it goes down in value, they can buy it back at the lower price and pay back whoever they borrowed the shares from. So just to give an example, these are not real numbers for GameStop right now because they're kind of crazy, but let's say GameStop was at $50, right? And if I were to short it, I would borrow some stock and sell it for $50, and I would hope that the stock price goes down to say $20. And then when the stock goes down to $20, I would buy back, which is also known as covering. So I would cover at $20. And so I'm making that profit of $30 because I sold it at $50 and I'm buying it back at $20. So I've made a profit of $30. On the other hand, short selling has huge risks, pretty much infinite risk, infinite downside, infinite losses, because the stock price could go up forever, right? So on the flip side, let's say I short it at 50, meaning I borrow some shares to sell at 50 and I want it to go down, but it actually goes up. So let's say it goes from 50 to 100, for example. Well, in that case, it could keep going up, but let's say it goes to 100. Those stocks were not mine. I borrowed that stock and I'm paying interest. Those shares are basically on loan to me, right? So I'm paying interest on that as well. And I need to buy them back to give back to the person who loaned them to me in the first place, right? So I borrowed them at 50, but now they're at 100 and I need to buy them to give it back. So if I buy it at 100, I'm paying $50 more than what I sold them for. So I'm actually losing that 50. And so why short selling is so risky is because there really is no cap. If you're hoping to buy stock and it goes up in value, if it goes down, the lowest you can go is zero, right? No stock is going to sell for like negative $100 or negative 200, whatever, right? The cap is at zero. The maximum you can lose if you go long or if you buy a stock is however much you bought it for, right? So if I buy it at 50 and it goes down to zero, I lose $50 maximum. But if I short a stock and I sell it for 50 and I hope it goes down, but it goes up, there's no ceiling. It could go 100, 200, 300, 1,000, 100,000, a million, to the moon or the Mars, whatever the Reddit people are saying right now. So it could go up forever and your loss is basically uncapped. And that's what makes short selling so risky? So hopefully that was a good or subpar explanation of what short selling is, so you kind of get an idea of what is going on right now. So that's just some background and some terms that we need to know in order to understand what's going on. So now we can get into the juicy, the drama part. So what basically happened was, and I'm going to give you a little bit of history going back. In 2020, around August, end of the year, Ryan Cohen, who is an executive and co-founder of Chewy, which is the online pet food, pet supply retailer store, he basically bought around 10%, I think like 12.9% total shares in GameStop. And so, you know, he has a lot of experience in e-commerce. Chewy stock has been doing very well, and I regret not buying it. But anyway, when retail investors are normal people, normal investors like you and me, when retail investors saw that, you know, the Chewy executive, who's been pretty successful, bought basically a 10% stake in GameStop, that raised their hopes for, you know, how GameStop is going to do as a business. They were like, oh my God, hope for greater leadership. You know, maybe the stock is going to do well later. And so they bought it. And so that stock went up a little bit, right? And so what happened at this point was Wall Street, you know, the hedge funds, the banks, they're like, oh, these stupid retail investors, they don't know anything about the fundamentals of business. You know, GameStop losing money, bad business model, brick and mortar, blah, blah, blah. And they were like, basically the fundamentals of GameStop doesn't support such a high valuation that what all the retail investors were going into. Because if you think about it, GameStop was losing money at the time, and if they stay with their brick and mortar model, I personally don't think it's sustainable because you can get everything online. So that's basically what Wall Street was thinking in their heads. They're like, you know, these retail investors are making the price go up because they saw great leadership, and so they want to buy it. So the demand went up, so the price went up. And so Wall Street was like, okay, well, the fundamentals of the company does not support this. I think the price is going to go down. And so a lot of hedge funds, a lot of banks started shorting the stock, which means they hope that, you know, the price will go down. They were borrowing shares to sell so that they could buy it lower because they think it's going to go lower. And so what actually ended up happening is a negative flow occurred. And so what that means is the number of shares shorted was actually greater than the number of actual GameStop shares there are, which is very risky because remember, when you short a stock, you're borrowing stock and you have to buy back to give it back to the person. But when you short and you borrow more than there are actually shares available in the market, that's just recipe for disaster. But anyway, what happened was in the Reddit board, it's called Wall Street Bets. I'll probably put like a screenshot here. They realized that they controlled most of the shares. Because all the Wall Street, you know, hedge funds, banks, they were shorting it, so they're obviously not holding on to the stock. So most of the shares of GameStop were in the hands of retail investors. And so, you know, these retail investors, they're called like the little guys, they wanted to get back at the big guys. So basically what happened is they talked amongst themselves, made an agreement to make the price go up. Basically, that's what the short squeeze is, right? They're squeezing the short, the people who shorted the stock out of the position because they need to buy back the stock to cover. And so what the people on Reddit did is they basically inflated the price. How did they inflate the price? Well, the reason that stock prices go up is a simple question of supply and demand. When things are in demand, the price is going to go up. Just think about, you know, the PlayStation 5 that comes out, you know, when a lot of people want it and there's not a lot available, that price is going to go up because you want it, right? And especially when supply is low, that is going to drive the price up. Think about oil prices as well. So basically what the GameStop people, the shareholders on Reddit realized is if they chose not to sell any of their stocks, they just held onto it, and if they wanted to keep buying, they could kick the price up because as more people buy, the price is going to go up, right? But these short sellers want to cover their position because they see the prices going up as well, and they need to cover because the more the price goes up, the more money they lose. But nobody's selling, right? So the supply is low, so they have to keep bidding up the price in hopes that somebody will sell at that price that they want, or they have to keep bidding higher until somebody is willing to sell at that price. So in short, what's happening, the Wall Street banks or hedge funds are trying to cover their position, so they're trying to buy some of the GameStop. They're trying to buy back some of the GameStop stock so that they can cover their positions, but nobody's selling. And that is in turn driving up the price. And when they do buy, you know, that's more demand in buying. So that also drives the price up. So people are buying, whether it's retail investors because they want to get in on the hype, or the Wall Street people, hedge funds and banks who are buying to cover their positions, they're also buying with lower number of people selling, and that just, supply and demand, the price just keeps going up and up and up, and the people on Reddit just want to, drive it to the moon or Mars is what they say, so they're hoping to break 1,000. So that's basically the gist. They wanted to make the Wall Street hedge funds hurt a lot because most of the stock was held in the hands of retail investors, so if they don't sell and they keep buying, the supply is low and the price goes up, so Wall Street needs to get rid of those, so they keep buying. And when they try to buy, the price keeps going up, and that's what we're seeing right now. So that's basically an explanation of why the stock is going absolutely crazy. And now I kind of just want to briefly share what I am personally doing. You don't have to listen to me, and I'm not here to give advice, but just my perspective on things. This is very similar to what happened with Volkswagen. Volkswagen is known as the mother of all squeezes. Like, it was the biggest short squeeze ever. I think it went up to like 1,000 euros. When you look at the chart, it doesn't even show up, but if you research, it went up to 1,000. And the point there is, I'm not going to go into the background of why that happened, how that happened, but I think the lesson we need to learn here is, I personally invest for the long term. I'm not a day trader. If you're a day trader, maybe you want to consider getting in, who knows? But personally, I am not a day trader. I like to invest in companies that I like and I believe in, and for the long term. And GameStop, I don't believe the fundamentals are there personally. Maybe it does do really well, but I think at 300 something, it's not worth that price. And if you look at what happened to Volkswagen, maybe I'll put a screenshot of a graph of what happened to Volkswagen. But if you look at the graph, what happens was in 2008, October, it peaked to the very high point when, it was being squeezed, and it came back down to what it was worth. So that's exactly what I think is going to happen to GameStop. Right now, all the craze, people are buying, nobody's selling, and, we're like, we want to hurt Wall Street and all that. But in reality, most of those hedge funds / banks have already covered their positions. So even though they took it at a loss, they've already covered. And so what I think is going to happen is, sure, demand is going to go up and up and up and up, and I don't know what exactly the price is going to peak at, but at some point, those Wall Street people, they are going to cover their positions. There's a lot of institutional money that is, at the end of the day, going to cover that. So what I think is going to happen is, at some point, this craze is going to end, and then people are going to realize, GameStop, the fundamentals just aren't there. They're losing money, and if they don't change their business model soon, I think they're already pretty behind, in my opinion. But people are going to realize it's not worth that much, and they're going to start to lock in their profits. A lot of people right now, they've made millions. They've turned, 5 figures into 7 figures or potentially even more. And they're holding on right now because they want to make the Wall Street people hurt a little more. But at some point, the Wall Street people, most of them have covered their positions, and some of those people are going to want to lock in those profits, right? How do you lock in the profit? Right now, it's called an unrealized gain because you haven't sold. To realize that gain, lock in that profit, get that cash, they have to sell. And what happens when people sell? Supply and demand. The shares are going to flood the market, and I think the price is going to go down. So personally, I invest for the long term. I've only sold one stock, like literally one share of one company in my entire investing career, and I invest in companies that I think have potential or that I believe in for the long run. And I just don't think GameStop is at that point right now, especially at 300 something right now. So even if right now it goes to say 400, 500, 600, even 1,000 or more in the next few days, sure, I'll be sad. I won't be sad. I'll be like, I could have got in at 300 and got all that profit. But at the end of the day, it doesn't affect me that much. And on the flip side, let's say I buy at 300 and it goes all the way back down to $20, right? That's a big loss for me. So I just don't think it's worth it. I wouldn't get in. I think it's a craze that will, maybe last for maximum, let's say, a month before it starts going down. That's just personally what I think, and from what history showed. Volkswagen, they weren't that great, but they had a really big squeeze up to 1,000, and then what happened? It came back down. So that's what I think is going to happen to GameStop. So I am not buying. I do not own any shares of GameStop, although I wish I did, but no regrets either. So that's just my opinion. I will not buy. If you want to buy, go ahead. If you want to let me know what happened in the comments below, please do. If I am too verbose, please let me know, because I think I talk too much. But anyway, hopefully this was an easy to understand kind of explanation. I know I talked a lot, but let me know if it was helpful. I tried to keep a lot of technical terms out of the way while still defining some important to know terms. So let me know if any part of this was helpful. Leave a like if you'd like to, subscribe if you'd like to. If you really want to, you can dislike, but A like would make me smile, and I like to smile, and I hope you smile too. So I hope you guys have a beautiful day, and yeah, bye.